have a large debt, such as a mortgage, you may be unsure about how to use extra cash, like a windfall, bonus, or raise. Prepaying your home loan ahead of schedule allows you to eliminate debt faster, but investing extra money may allow you to grow your balance faster. This video will help you know the best money move to make. Hi, I'm Laura Adams, an award-winning personal finance author and Money Girl podcast host with 43 million downloads. For over a decade, I've helped millions of readers and listeners understand how to manage money and build wealth. Our goal is to give you tips and advice that you can put into practice right now for more financial security and success. So to prioritize your finances, ask yourself the following questions. One is, do I have enough emergency savings? How much emergency money you need depends on your income, expenses, debt payments, and goals. Consider keeping at least 3 months of living expenses on hand. For instance, if you spend $4,000 monthly on essentials, you might maintain a $12,000 balance in an FDIC-insured high-yield savings account. Also ask, do I have the right insurance? Having various insurance policies like health, life, disability, auto, and homeowners or renters is another essential way to prepare for potential risks. So review your insurance and fill any coverage gaps with your extra cash before prepaying a mortgage or investing. Ask, do I regularly invest for retirement? A good rule of thumb is to invest a minimum of 10 to 15% of your gross income for retirement. You might use a workplace retirement plan, an IRA, or an account for the self-employed. So if you answered yes to those 3 questions, you're ready to prepay your debt or invest more. So the next step is listing out your debts and then sorting them from highest to lowest interest rate. In general, that's how you should pay down debt. Remember, you get less benefit from prepaying lower rate tax deductible debt like a mortgage or home equity loan or even a student loan. Instead, you could invest your extra money for higher returns. But if you have debt with double-digit interest rates like credit cards or maybe a high-rate loan, your best financial move is to pay them off early and save the interest expense. Let's say you take out a $500,000 mortgage at 5% interest for 30 years, and you pay 10% or $50,000 down on the loan. Over the life of that mortgage, you'd pay nearly $870,000 in total payments. But if you sent an extra $500 payment and an extra $100 monthly to your payment, you would shave 2 years and 7 months off your repayment schedule. And you'll save over $43,000 in interest. Not bad. But what if you invested all that money in the S&P 500 instead? It averages an annual 10% return. That would give you nearly $160,000 over the same period. So that's roughly an extra $117,000. Before investing extra money or sending it to pay down a debt, be sure you keep enough emergency money in the bank. And if you're still conflicted about a debt versus investing issue, you can always do both, right? For instance, you could invest half your extra money and use half to repay your highest rate debt. To learn more about investing, visit finder.com. And thanks for watching. If you like this video, please subscribe. You'll get notified when there are more helpful tips, product reviews, and money advice.